Is the 2023 recession killing real estate? This is one of the biggest questions I'm getting lately, and you're not going to believe the answer. Today's episode is sponsored by Sovereign Title. They take pride in offering exceptional services to all parties in the real estate transaction, and they create a pleasant, stress-free closing experience. Our title sponsor for the show is First Access Mortgage. They are Louisiana's first choice mortgage company for the last 21 years, and we're really excited to partner with them if you need to buy a home, your first home, a vacation home, or invest in real estate. They're truly your home loan resource. So go check them out, First Access Mortgage. Back to our question, is the 2023 recession killing real estate? So the short answer is no, absolutely it is not. This is the Will Frederick podcast where we talk about real estate, wealth building, money, and life. So we're going to dive in. I'm going to talk about the real factor that drives the real estate market and give you a hint. It's not interest rates. So the real factor that drives the real estate market. I'm also going to talk about why the Federal Reserve doesn't actually control mortgage interest rates. We're also going to talk about what does control mortgage interest rates. And then we're going to talk about why we are not headed into another 2006 style recession. So I'm going to share some facts with you about what's actually going on and why news is not as bad as what you might be hearing. I want to talk about facts for a minute. Facts give perspective. Most of the time with real estate, we're talking about some of the biggest purchases most people ever make, biggest financial investments. It's very easy to get emotional about that because it's a little scary. Some examples of what you might be hearing right now: rates are higher than they've been in a decade. So that's true, but you have to add some perspective to it. So the reality is the long-term average interest rate is between 5 to 7%. So it's more factual to say that rates have actually returned to normal. So they are higher than they've been in a decade. Over the longer term, they're back to normal. Another example of housing prices are higher than they've ever been. And that, again, is true. However, the reality is that housing prices usually go up on average over time about 4% per year. So it's actually pretty rare that housing prices aren't higher than they've ever been. Over time, you should see a market increase in housing prices. So that's the difference between facts and then perspective that give you the reality surrounding that. So statistics get you out of emotion and put you into logic. And that helps. Logic helps you make the best decision for your particular situation because every situation is different. So in the Will Frederick team, we like to help people get out of emotion, get them into logic so they get to make the decision. I'm not the boss, you're the boss. That's what we specify on our team. We're advisors to you getting to make your own decision. People ask me, should I sell? Should I buy? Well, it depends. The answer is not a simple yes or no. It's a little more complex than that. Everybody's got different goals and motives for selling real estate. There's no one size fits all. Here are some answers that will help you decide what's right for you. Big question: what is the main factor that drives the real estate market? It's the same thing that drives every market from the beginning of time: supply and demand. I have an undergraduate in business administration, a master's in business. Supply and demand is like your bread and butter. That's what you go to, supply and demand. It's every market driven from the beginning of time. So the way that looks in the real estate market, supply is home builders putting new inventory on the market. So new homes being built, not existing homes, because a sell is a buy. So it doesn't add inventory, new homes. That's what is supply. Demand is measured by household formations. So when a kid moves out of their parents' house and goes and gets a new house, that's demand, new household formations. So that happens on average in the United States at the average age of 33 years old. So that might be surprising to some of you. It was to me. It happened a lot younger in my case, but on average, it happens at the age of 33. What creates a bubble like the one we saw in 2005 and 6 mainly is supply and demand being out of whack. So first, we had some really crazy lending practices leading up to that time. The crazy lending practices were kind of encouraging irresponsible rates of home ownership. Stuff like no income loans and low credit scores were being really incentivized to buy homes. So you had high rates of home ownership. You had a lot of demand. And then we had record rates of home building. So a lot of supply hitting the market. So that was why the market was so on fire. A lot of supply, a lot of demand. What happened though, in 2006, demand dropped off a cliff like overnight. It was crazy how much it just dropped. We saw a dramatic drop in new household formations. And what are new household formations? Remember, that's the number of 33-year-olds going out and buying new homes. So I wonder why. Why did that happen? When I learned the next thing I'm going to tell you, I was shocked and amazed. It seems to have nothing to do with real estate, and it's this. What happened 33 years before 2006? The year, if you do the math, the year was 1973. Anyone have any clues? What happened in 1973, in January of 1973, abortion was legalized in the federal case Roe versus Wade. What happened after that is we saw a dramatic drop in the birth rate that year in 1973. The next year, another dramatic drop in birth rate, those 2 years. And then 6 years after that, the birth rate remained very low before it started to come back. So we had an 8-year dramatic drop and stay low of birth rate. So what happened is 33 years later, in 2006 and 2007, and for 6 years following that, we saw significantly less demand. So pretty amazing stuff. You never thought those two things were related, but you have to look at demographics when it comes to supply and demand. So hopefully that will give you a little bit of context about how the birth rate does affect supply and demand and what drives our real estate market today. And we're going to get into, later in the show, we're going to get into why we're not headed for another 2006 style recession. First, however, I want to address the next question, a very, very common misperception I have, or not I have, but a very common misperception that people ask me about. And this is why the Federal Reserve doesn't actually control mortgage interest rates. So yesterday, I was sitting at a client's table and I said, hey, the rates have come down. He said, wait, I thought the rates were still going up. A perfect example of this common confusion about what the rate is and what rates we're even talking about. Most people don't realize this, but the federal funds rate, which is the rate that they've been raising, and mortgage interest rates are two different rates. What's the difference? So the federal funds rate is a tool that the Fed uses to basically influence the economy. What it is it's the target rate for borrowing and lending between commercial banks one to another. So the Federal Reserve sets that rate. It's usually a range, 4.5 to 4.75 is where it is right now. That's the range they say that banks can lend to one another. By the way, the long-term average of that rate is 4.6%. So where we are right now is actually considered healthy. Part of the reason they like it to be, have some meat to it is so that they have some place to lower when they need to incentivize the economy. So right where we're at now is a good place. That's a federal funds rate. That's the rate that's going up, that people hear that and they think, oh, the rates are going up. That rate is going up. Mortgage interest rates are what lenders charge for a home purchase. So when you go talk to First Access Mortgage and you say, hey, I want to buy a home, I want to refinance my home, that's what they're charging for a home mortgage. And so that long-term average is between 5 to 7%. And so the past decade was unprecedented lows because of the Great Recession. So I remember that, like, my first house was actually 6.875, and my parents thought I'd won the lottery because theirs was in the teens, I think 12 or 13%. So you got to look at these things with some perspective. Right now, you can get a mortgage in the low sixes. Sounds high compared to the last 10 years, but it's really pretty great on average. So 5 to 7% is on average. Again, it's more accurate to say they've returned to normal. The rate does affect affordability, and that is, obviously a factor when it comes to buying a home, but it's not the primary factor that affects the interest or the real estate market. Interest rates do have an influence, but they don't determine the market. So one quick rule of thumb that may help you on a 30-year note with a 1% rate increase, so when the rate moves from 3% to 4%, that represents about a 10% increase in the payment. So even though the rate might have doubled in the last year, right, from 3% to 6%, the payment has only increased by 30 or 40% in most cases. So it's still a lot, but it's not as bad as you might think. So the next question we have to address is, what does control the mortgage interest rate? If it's different than the Fed funds rate, what's the difference and how is that affected? So the answer to that question is inflation. Then you have to ask, what is inflation? And inflation is very simply defined as too many dollars chasing too few goods. So when you have a limited amount of supply of something, the demand outpaces it, the price goes up and things inflate. Supply and demand makes the prices inflate. People are paying more for the same thing because their dollars are competing for it. So let me explain how that affects the mortgage interest rate. Whenever you receive a fixed payment over time, like a mortgage, inflation, when things go up in price, inflation whittles away that buying power. So the same dollar buys less next year. It doesn't buy as much since the prices has gone up. So does that make sense? The power of that dollar does erode over time when inflation is happening. So when inflation is low, that erosion happens very slowly, and so mortgage lenders can afford to charge a lower interest rate because they need to recover less of the dollar when inflation is low. That's when it begins to erode very slowly. Now, when inflation goes up, as a result, the mortgage rates have to charge a higher rate to offset that erosion because the erosion has sped up when inflation goes up. So as you can see, the mortgage interest rates follow inflation because the lenders have to make up that dollar later on. Inflation goes up, and as a result, mortgage rates go up. This is why the mortgage interest rates have come down in the last several months, even though the Fed has continued to raise their Fed funds rate. Hence the confusion of my client yesterday and many of us in the general public that fail to realize there's a difference between those two. I mean, nobody explains that to you. That's why I'm here to explain it to you, to help you understand, hey, the Fed funds rate could go up. That's actually helping the mortgage rates come down because the Fed funds rate is being raised to control inflation. That's the purpose of them raising the Fed funds rate. So their goal is to help slow the inflation, and it's working. And that's why the rates come down, the mortgage interest rates come down. So, for instance, last June, when the inflation numbers came out, the consumer price index, which is how they measure inflation, was actually 9.1% in June of 2022. And this past December, when they just came out, it was down to 6.5%. So they've pulled inflation down from 9 to 6.5. Now, ideally, they want it to be at 2%. So 6% is still kind of high, which is why, by the way, the Federal Reserve continues to give guidance that they're going to raise the rates because they want to bring that inflation down to that 2% range. It's still at 6. But what they're doing is working. And it's very imprecise. They have to like gauge it. They can't, it's not an exact lever. They have to raise it a little bit, see what that does, raise it a little bit more, see what that does. And that's what they're doing right now. And they're planning to continue raising rates, which means inflation should continue to slow and interest rates will follow suit. We don't really know exactly what they're going to do, but a lot of folks in the industry are saying they'll probably settle in the mid to low 5s. They'll still come down a little bit from where they are right now, but we're not really sure. If you want to hear a much more detailed treatment of these numbers from an expert who knows a lot more than I do on the subject, check out the video I'll link by Barry Habib. I promise you'll learn a whole lot. He's an excellent resource. That's if you want to get into a little bit more nitty gritty. So the next question I want to address here is why we're not headed for another 2006 recession. So this is going to be good news to most of you, and it really is good news. The fundamentals on what's going on in the market are way different this time than they were, 20 years or almost 20 years ago at this point. It gives me a lot of hope about the long-term outlook for home appreciation. And here's what's different this time. Talked about the crazy lending practices. Leading up to this housing boom, there haven't been any lending practices that are out of this world crazy. Lenders are still being very conservative. I don't know if you've tried to get a loan lately. It can be pretty painful. Unless you go to First Access Mortgage, it won't be painful at all. So if you get a loan, though, they're going to want a lot of information. They're going to give you a lot of support. They need a lot of supporting documents. The crazy lending practices where all you had to do was basically, check your pulse, and if you were alive, they gave you a loan. That's not happening anymore. That's a really good thing because that means that more responsible rates of home ownership are happening, and it's very healthy. The other thing that's a big factor is that builders, remember new home inventory coming onto the market, builders have not hit those record rates of home building by a long shot. They're very stable. And as a matter of fact, if you look at our industry right now, we're actually short on supply. Short on supply and heavy on demand means that the prices go up. So we're still catching up from the Great Recession when very little houses being built. That inventory is still absent. So builders are still catching up. So there has not been record rates of home building, which is a good thing for the market. It's not overloaded with supply right now. So demand is still, there's a tension on that supply and demand. The other great thing, remember we talked about birth rates earlier and that interesting fact about Roe v. Wade. So if you look at the birth rate for 33-year-olds, back in the 90s, especially 1990, right? The year we're entering right now is 2023. Subtract 33 years from that and you have 1990. The birth rate was really healthy in 1990. So you had, You've got a crop of 33-year-olds coming online this year that are going to go out and buy houses. And by the way, all throughout the 90s, it stayed relatively healthy. It was very, very normal, the birth rate. So you're probably not going to see a drastic drop in demand, which is going to keep that home building price or that home price, relatively healthy. One other factor that I found pretty interesting when I was looking at the stats, the average home equity in 2006 was 19%. So that means people had 19% equity in their house. The average home equity today in 2022 or 2023 is 58%. So whereas people might have walked away from, on average, 19%, they're going to be much less likely to walk away and create this national foreclosure crisis at 58% equity. And that's on average. So you're going to have some foreclosures, but I don't expect to see anything crazy. Those are the reason that the factors are way different. So remember, supply and demand is the key factor here. And inventory is the number of months it would take to sell all available homes if no more homes were listed. So as a listing agent in the real estate industry, I look at this statistic in our local market and I look and see how many months of inventory we have. So in other words, if I stopped listing homes today, if everybody stopped listing homes and we kept selling at the same rate, we'd have this many months we'd sell out. And on average, our market, on average, not a buyer's market, not a seller's market, is considered between 5 to 7 months of inventory. Well, we're at about 2.5 months of inventory on the North Shore, Tangipahoa and Hammond in specific. So 2 to 2.5 months of inventory, that's still considered a pretty significant seller's market. The reason that it might feel slow to some people is because for the last couple of years, we've been at like 1 month or less of inventory. So homes just are flying off the shelves. Now the inventory is literally doubled, but it's still well below what's a natural normal market. So I would say that there's not a lot of cause for concern in this realm. And this is where trajectory and speed really kind of comes to the forefront, because if you've just in this lightning fast market, if you just slow down a little bit, you still could be going faster than normal, but it feels a lot slower. And that's simply what we're experiencing that right now. It's going to feel like a very different market than actually what it is. I look at these numbers every few days. I watch them like a hawk so I can best bring advice and value to our clients. Because we're only 2 to 2.5 months of inventory on the North Shore, that's a really good thing. And so I think it's still a very healthy time to buy. If you've got to get in a little bit higher interest rate than you'd prefer, and of course, compared to a couple of years ago, that's natural. Don't be afraid of that. Marry the house, date the rate is what we're telling people. You can always refinance later. Use the gift of this market where there's not 25 people going after the same house. Get in there, buy the house at a fair price, and then later on, refinance if you need to. So if you found this helpful, we'd love to talk about your situation. The sky is not falling, and there's plenty of room for optimism. Real estate continues to be the best investment. In the next few episodes of our show, we're going to get into one of my favorite topics, which is investing in real estate and creating wealth through investing in real estate. So meantime, we can help you answer specific questions. We love to help people navigate to their next step in achieving their goals. If you have a specific question about your situation, leave a comment down below and we'll start a conversation with you about your situation and your specific context. If you found value in today's podcast, hit the subscribe button below. We don't want you or anyone else to miss out on any more of our conversation when we talk about real estate, wealth building, money, and life. Also, I'd like to thank today's episode sponsor, Sovereign Title. They take pride in offering exceptional services to all parties in the real estate transaction. They create a very pleasant, stress-free closing experience. Definitely want to thank our title sponsor as well, First Access Mortgage. They have been Louisiana's first choice mortgage lender for the last 21 years. We're excited to be partnered with them. If you have any kind of home loan need, they are truly your home loan resource to buy a home, a vacation home. Go check them out, and we will see you next time.